Hello everyone. In this video I'm going to cover chapter 4 of the financial accounting course. Chapter 4 has to do with adjusting entries. Basically, adjusting entries are concerned with the fourth step of the accounting cycle. So in the first step, we journalize the entries. In the second step, we post those accounts into T accounts or ledger, the ledger. In the third step, we prepare a trial balance. In the fourth step, we adjust our entries, and I'll explain what we mean by adjusting the entries in a minute. And in the fifth step, we prepare an adjusted trial balance. So in this chapter, we will cover the steps, the fourth and the fifth step. Adjusting entries, as a matter of fact, adjusting entries are two types: deferrals and accruals. Under deferrals, we have an asset and a liability. Under accruals, we might deal with revenues or expenses. Deferrals is when you defer the payment or the receipt of cash. Accruals, the payment or the receipt of cash happens after the adjusting entry, which involves accruals. When something accrues, it means that it should have been paid or it should have been received, yet it hasn't been received or paid. An example of an accrual is account receivables. Receivables, you should have received as a company or corporation the payment from the customer, yet you haven't. Another example is account payable. Payables is when you should have paid your supplier, yet you haven't. Deferrals, on the other hand, take place after the payment or the receipt of cash. So you either pay in advance for a service that you will consume over a period of time in the future, or you receive a payment in advance for a service that you will provide in the future. Okay, so briefly, deferrals happen or take place after the payment, after payment or receipt of cash. So after. On the other hand, accruals take place before the payment or receipt of cash. Okay? Now, while preparing our adjusting entries, we will be using or employing two main accounting principles that were introduced in chapter 3, the matching principle and the realization principle. To remind you, the matching principle states that all expenses must be matched or linked to a revenue generating process. Also, just a side note, expenses are incurred when services are used, when services are received or used, and not when cash is paid. So you might use electricity service, for example, utility services, and pay after a while. You will incur the expense and it will appear in your income statement before paying the cash. The realization principle states that all revenues are earned or recorded when services are rendered or goods are sold. Goods are sold, and not when cash is received. So you might provide a service or sell a good today and get paid after 1 month. The revenue must be realized or recorded today, because today you provided the service or sold the item or the good. Now, what I'm going to do is that I will introduce the 2 types of deferrals and the 2 types of accruals and show you how we do the adjusting entries in the 4 cases. So under deferrals, so let's say 1 deferrals. So I will have 1 and 2, then 1.1, 1.2, 2.1 and 2.2. Okay, 1 are deferrals. The first type of deferrals, so 1.1, is called a prepaid expense. Unlike what the name might convey, prepaid expenses are asset. So a prepaid expense happens when you pay for an expense that you will consume in the future. A very simple example is when you top up your SIM card. Today, if you topped up your SIM card with $20, today you own those $20. So today, this prepaid expense is an asset. It's not an expense. When you start making calls, you will be converting this asset into an expense. So when you make the first call, let's say the call costs you 25 cents, 25 cents out of the $20 were converted from an asset to an expense. So prepaid expenses, it is an asset that will be converted into an expense. So again, prepaid expense is an asset. Okay, it's an asset. In this type of adjusting entries, we apply the matching principle. So the matching principle is applied. And I will show you in a minute how the matching principle is applied. Let's take an example. The example says, on August 31, 2020, you pay 1 year of rent in advance. Therefore, until August 30, 2021. The given says also that you close your financial year on the end of December of each year. One common thing across all adjusting entries is that all adjusting entries take place on the last day of the accounting cycle. So if you close your accounting cycle or accounting period at the end of each month, then you will have to adjust your entries at the end of each month. If you close it semi-annually, at the end of 6 months, you will have to do the adjusting entries. If you close it annually, just like here, you do it once at the end of December, you will have to do the adjusting entries at the end of December, the end of the calendar year. Now, the timeline looks like that. This is August 31, 2020. This is December 31, 2020. And this is August 31, 2021. The adjusting entry takes place here. This is the adjusting entry. And on August 31, 2020, you pay 1 year of rent in advance. So this is the prepaid expense. The payment in advance is the prepaid expense. Prepaid, you're paying ahead of time for something that you will use in the future. On August 31, the prepaid expense, or rent in this case, expires. Okay? Now, you will have two entries. The first one is over here and the other one is over here. The adjusting entry is on December 31. So what happens on August 31? What happens is that you pay 1 year in advance. So when you pay, it means that you will credit your cash and you will debit your prepaid expense. Instead of using the term expense, we will use rent, prepaid rent. Okay, it can be prepaid insurance, prepaid rent, anything that is prepaid, that is paid ahead of time, will have the prefix prepaid. So prepaid rent, assuming it's $12,000, so as if it's $1,000 per month, and the same value for cash, $12,000. Now, on December 31, you need to adjust your entries. Adjust it in what sense? In a sense that you need to deduct out of those $12,000 the value of the rent that you used as a corporation. From August 31 till December 31, you have 4 months, September, October, November, and December. So 4 out of 12, 12 is the year, 4 out of 12 is the value that should be converted from an asset to an expense. So it will become a rent expense and it will appear in the income statement of the year end. So on December 31, you will credit this asset by 4,000. So prepaid rent now is in the credit, $4,000. How did I get the 4,000? It's basically 4 over 12 multiplied by $12,000. Okay, 4 out of 12 months. On the debit, it's the expense, which is the rent expense. Now my income statement will show a rent expense of $4,000. This is the adjusting entry. Okay, so when you are solving an exam, solving a problem or in the exam, and you are asked to adjust your entries, this is the adjusting entry that you should use. This one is to complete the cycle, to complete the story. Okay? Now, the point here, the important point is that we use the matching principle in a sense that if we didn't use the matching principle, this income statement on December 31 will include the $12,000 as a rent expense, which doesn't make sense because this rent, 2/3 of it, which is 8 out of 12, are included in should be included in the income statement of 2021 because it falls in the territory of 2021. So the matching principle says that in the revenue generated during 2020, we only used $4,000 out of the $12,000 as an expense. So $4,000 out of this value are matched to the revenue generating process of 2020. Okay, this is the concept of applying the matching principle in this case. The other type of deferrals is a liability. So 1.2, this liability is called an unearned revenue. Again, it is misleading. Unearned revenue is not a revenue, it is a liability. And when we say unearned, it means that we received a payment of in cash ahead of time, ahead of providing the service. Example, I have a company that provides cleaning services. Some other company came to my company and asked that if I may clean their offices. I agreed, so they paid me in advance $10,000 to clean their offices. Okay? As long as I haven't provided the service to them, so I received the cash and I haven't provided the service to them, it is a liability in my accounts. Now when I receive the cash, my cash increases and my liability increases as an unearned revenue because I haven't provided them the service. When I provide the service, then I can say that this liability doesn't exist anymore and I deserve to earn the revenue. So my revenue appears in the income statement. However, if I receive cash in advance and I don't provide the service, there shouldn't be any revenues in the income statement. And this is the realization principle. So unearned revenue is a liability that will be converted into a revenue. In this type of deferrals or adjusting entries, we apply the realization principle. Okay? Example. You receive $12,000 to provide a marketing campaign for another company for the next 12 months. Okay? So you'll provide a marketing campaign for some other company over the next 12 months. You receive $12,000, so obviously it's $1,000 per month to do them their marketing campaign. You receive the payment on April 1. On April 1, 2020. You close your financial year on December 31 of each year. So the timeline will look like this. On April 1, 2020, on December 31, 2020, and finally on March 31st, 2021. On April 1, you receive the cash. Receive cash. On December 31, adjusting entry. On March 31, the marketing campaign ends. Okay? Now, when you receive the cash, you owe the other company $12,000 worth of services, of marketing services. So here you need to record a liability in return for this cash that you received. So you will debit your cash, which is the asset, by $12,000 and credit your unearned revenue, which is the liability, by the same amount. On December 31, you will have provided how many months? 8 months. April, May, June, July, August, September, October, November, and December. Actually, it's 9, not 8. So 9 out of 12. 9 out of 12, because 9 fall in the 2020 and 3 falls in the 2021. So this 9 should have been shorter, but it's okay. So to adjust the entries, you need to realize out of the $12,000 of liabilities, $9,000 as a revenue. So you are now less liable to the other company by $9,000. So my liability will decrease, and as we know, liabilities decrease by debits, 9,000, and my service revenue increases by $9,000. So, and of course, I'm talking about this date. This means that my income statement in 2020 will include $9,000 as revenues. Okay? Not all the $12,000 and not a zero. Here, when we had the prepaid expense, this value, the $4,000, will be included in the income statement. So we will not include the whole $12,000 which we paid for rent in advance. No, we only used 4 out of 12. This is everything that has to do with deferrals. Now, moving to accruals. Accruals are simpler than deferrals. So point 2, accruals. Accruals, the first type of accruals is the accrued expense. So 2.1, we're talking about accrued expense, and it's very simple. When you use a service and pay later on. So today you used a service, you will incur the service in the debit, and you have a liability to be paid later on. Think of the utility expense, because usually utility bills are collected after some time. So as soon as you use this electricity or water or whatever, the utilities, you will incur it in your income statement. And after a while, when you pay, you will remove this liability and decrease your cash. So accrued expenses, in accrued expenses, so it is an expense, okay? It is an expense. It's not like the prepaid expense, which is an asset. Accrued expenses are expenses. It is an expense in which you accrue an expense. Okay, it's self-explanatory, to be honest. In this concept, or in this type of accruals, we apply the matching principle. Because simply you are incurring the expense upon using the service, not upon paying. The example says you receive a service, let's say that at the end of May, your interest expense for the bank loan that you have is let's say $1,000. You pay your interest expenses semi-annually. Semi-annually means that at the end of June and end of December. So you pay it twice a year, semi-annually, every half a year. So this is May 31, and this is June 30. On May 31, the interest expense has accrued. Accrued simply means that it should have been paid on this day, yet you haven't paid. Yet you did not pay on that day. On June 30, you paid the accrued interest expense. So the accounting entry over here will be an interest expense, so it is incurred, and you haven't paid it, so it's a liability, so interest payable. Interest payable, any type of payable or kind of payable is a liability. On June 30, you pay it, so it's no more a liability, so interest payable, $1,000. So now we are decreasing liabilities because we paid for it in cash. So if you think about it, if time doesn't exist, time differences do not exist, this entry will cancel out with this entry, and you will have an interest expense that you have paid in cash. That's it. As simple as that. But because we have difference in timing, we need to do this adjusting. The adjusting entry is this one. This is the adjusting entry. As you can see, the adjusting entry in the case of accruals takes place before the cash payment or receipt. However, in the deferrals, the adjusting entry takes place after the cash payment or receipt. The adjusting entry in deferrals take place after the cash payment or receipt. Our last case is 2.2. It's called accrued revenue. Accrued revenue. Okay, accrued revenue is basically realizing realizing or accruing uncollected revenue. So it's like an account receivable. Here we apply the realization principle. So the realization principle is applied. The example says, you provide a service and get paid later on. So on May 1, 2020, you provided a service. And you got paid on June 30. So now you have 2 points. May 1, service is rendered. On June 30, cash is received. Okay? On May 1, when you provided the service and you haven't received any payment, you will have an account receivable. Let's say it's $1,000, just an example, and you will realize the revenue because the service is rendered, or the good was sold, or the item was sold. So it's a service revenue that is earned. You deserve to get paid because you provided the service. It's unlike the unearned revenue, where you receive cash in advance and provide the service later on. On June 30, cash is received, so you will simply increase your cash and you will remove the account receivable. So you're not expecting anything anymore from the customer. Again, if you think about it, if difference in timing doesn't exist, an account receivable will wash out with the other account receivable. You will simply have a debit in cash, so you received cash, and your service revenue was earned on the spot because you received cash on the spot. But given the difference in timing, apparently we need to use the adjusting entries. And this is our adjusting entry. Again, in accruals, adjusting entries take place before the cash receipt or payment. However, in deferrals, they take place after the cash receipt or payment. Now, as you can see, in each and every adjusting entry out of the 4 adjusting entries, the 2 deferrals and 2 accruals, we were either incurring an expense or earning a revenue. So in the accrued revenue, we earned a revenue. In accrued expenses, we incurred an expense. In unearned revenue, we earned a revenue or realized a revenue. And in the prepaid expense, we also incurred an expense. So in total now, if you think about it, in each and every adjusting entry, we are having one of the two, either an expense or a revenue. So in the prepaid expense, you will incur an expense. You will incur an expense. Okay? In the unearned revenue, you will realize or earn a revenue when providing the service, of course. So this is 1.1, this is 1.2, 2.1, the accrued expenses. You are incurring an expense, and finally in 2.2 you have accrued revenue. You are realizing or earning a revenue. Okay, so as you can see, in each one of them you either incur an expense or earn a revenue. Remember that all of these take place, they all take place on the last day of the cycle or the period, the accounting period. Therefore, in step 3 of the accounting cycle, step 3 of the accounting cycle is the trial balance. Okay? Step 4 of the accounting cycle is adjusting entries, which we learned how to prepare. In step 5 of the accounting cycle, you prepare an adjusted trial balance in light of those additional expenses and those additional revenues. So you will have a trial balance, you will do the adjusting entries, and then you will prepare an adjusted trial balance by incurring additional expenses that took place on the last day and adding the or realizing or earning the additional revenues which were also earned or realized on the last day of the cycle. So your adjusted trial balance will incorporate or will include those additional revenues and expenses that as a result of the adjusting entries. Thank you, and I will see you with a new